Joining us now is Jason Furman. He is the former chair of the Council of Economic Advisors. And Jason, it's great to have you back on the show. And actually, that's exactly where I want to start with you, because the thing that really sent markets lower today and Treasury yields higher was not the jobs report and some of those hotter metrics we just mentioned, but it was the University of Michigan report and the fact that we saw a jump in inflation expectations, in part tied to expectations around the possibility of tariffs. Do we have any sort of sense yet what reciprocal tariffs could mean or could be? And at what point do you start to see, if we do get them, start to see that show up in data?
Yeah, so consumers definitely showed they were more worried about inflation. Now, it's the preliminary survey. It's a small sample size. I don't believe the true jump was as big as the jump it showed, but I'm sure it went up. And it went up for good reason. The China tariffs are probably going to add about 0.1% to our inflation rate, but that's just 2 weeks in. There's a lot more tariffs that might be coming. They could easily add, 0.5 point to our inflation rate, depending on where we end up with them.
So what would you be watching in terms of data points to understand what this does to the broader inflation picture and how sticky it already has been?
Yeah. Now, tariffs in Trump's first term weren't a big deal for inflation. In part, they were much smaller. But back then, inflation was below target. Now we're starting with inflation above target. The real side of the economy, the unemployment rate, that's good. That is at target. So really, there's just risk going in one direction here. How big and how certain that risk is certainly unclear. But there's just a lot of different doors to go through for tariffs. Tariffs as negotiating leverage, tariffs as a way to raise revenue, tariffs to bring back jobs, tariffs to restore fairness. And the president keeps, at least knocking on every one of these doors. Which of them he's ultimately going to open, we don't know.
I do want to get your thoughts on the jobs report we got this morning. I've seen this chart circulating today that I thought was particularly fascinating, and it was showing that, based on the data we get in that monthly jobs report, that jobs for Americans have basically come up a little bit in the last couple of years post-pandemic and kind of stayed flat, and that jobs for immigrant workers, which they don't break down whether that is legal or illegal immigrants, but that those job gains have been much stronger in the last couple of years. So if that's the case, if you start to see this immigration crackdown and that happens in a bigger, more significant way here, and we already know it's starting to gain momentum, what does that do to the labor market and thus wages?
Yeah, I mean, the facts you said are correct, at least they're in the data. And it's a reminder that were it not for the inflow of immigrants, we would be losing jobs as a country. Our workforce is aging. People are having fewer children. And so our population would be shrinking. Our workforce would be shrinking. We would be posting negative jobs month after month were it not for immigrants. We saw immigration turn around starting the middle of last year. A big halt on the inflows of illegal immigration. What remains to be seen is what President Trump does on the legal side of immigration. Does he keep them flowing in? If he doesn't, it'll be very hard to get decent job growth or GDP growth.
So if we bring all of this fiscal policy back to the monetary policy piece of it, the fact that we've gotten comments from Fed officials today and this week that basically suggest inflation continues to be the most important metric that they're looking at and sitting on their hands, and maybe that we're closer to a neutral rate than previously thought, all of that makes sense?
Yeah, every piece of it. One, the real economy is fine. Two, inflation is a bit high when you look at prices. Three, when you look at wages, those are consistent with even higher than the price inflation we've been seeing. And finally, for all I know, we're already at neutral. I think we're probably above it, but I wouldn't be shocked to find out that this is actually a neutral interest rate. All of that, plus the uncertainty about tariffs we were talking about earlier, means it will be a high bar for the Fed to cut rates again. I think it will take a material rise in the unemployment rate for them to want to cut rates again this year.